Since 2022, SCHD has lagged the S&P 500, and a lot of investors are starting to wonder if it's still worth owning. In this video, I'll explain why I'm going to keep buying SCHD in 2026 for the portfolio I'm building on this channel. So here's the actual portfolio that I'm building on this channel. Right now, as you can see, SCHD is my core holding, making up the majority of the portfolio. I plan to keep adding to this position throughout 2026, and the reason comes down to a few simple things, starting with the goal of this portfolio. The goal here is to build a portfolio that generates significant dividend income in the future. I want a portfolio that eventually pays me enough in dividends to live off of. And the way I'm doing that is by investing in companies today that have a proven history of growing their dividends over time and that I'm confident can continue to do that in the future. And SCHD is an ETF built specifically around that idea. It's an ETF that holds high quality, cash generating businesses with strong dividend growth histories. Companies like Home Depot, which has raised its dividend for over 15 years straight, and Coca-Cola, a dividend king with more than 50 consecutive years of dividend increases. So right now, as I continue to build this portfolio and don't have a huge capital base to start, SCHD is the perfect ETF because it gives me broad diversification to a bunch of businesses that fit my strategy by design. Which brings me to the second reason why I'm going to keep buying SCHD in 2026, and that's diversification away from big tech. A huge portion of the S&P 500 returns over the past few years have been driven by technology companies. That's been great, but it also means a lot of investors are concentrated in the same names. SCHD, on the other hand, is built very differently. It tilts towards established cash-generating companies instead of growth-heavy tech. That means it can behave very differently in an event where technology stocks begin to sell off. Now, this doesn't mean I think technology stocks are going to sell off. In fact, I'm not even trying to pick which ETF will outperform in any given year. I'm continuing to buy SCHD because it does two things for me at the same time. It diversifies me away from big tech and gives me reliable dividend growth. To be clear, yes, SCHD has underperformed the S&P 500 over the last couple of years, and it's possible that it could happen again this year, and I'm okay with that. My goal is to build a portfolio of high-quality compounding businesses that eventually allows me to live off the dividends it produces 20 or 30 years from now. Now, over the long run, I'd like this portfolio to be competitive with and ideally outperform the S&P 500 as I continue adding individual companies on top of this foundation. But that's not something I'm going to force or chase by abandoning my long-term plan. I do still own growth-focused ETFs like SCHG in my retirement accounts, so I have plenty of exposure to technology and growth, but for this portfolio, SCHD is the base I'm building from. So far in 2026, SCHD has gotten off to a strong start with year-to-date returns beating the S&P 500. That's great to see. But whether SCHD has a strong year in price performance or not, I'm going to keep buying it as long as it does two things: continues to grow its dividend over time and gives me diversification away from big technology names that are in the S&P 500. So that's my plan. I'm going to keep buying SCHD in 2026 for the dividend growth and the diversification as I continue to build this dividend portfolio from zero. Let me know what you think about SCHD in the comments. I'd love to hear how you're approaching it. And if you want to follow along as I build this portfolio in real time, go ahead and subscribe. This is the Compound Journey. Thanks for watching, everyone.